If you've been researching about investments lately, or if you made the decision that you'll finally start in 2021, I'm sure you've gone through a lot of acronyms that you may not know the meaning of, and more so, you may not even understand what's the average or good enough return that you can earn off these investments. Stay tuned for the rest of the video. We're gonna discuss most of them, and I'll explain to you how you classify your risk profile and what are the choices you have. Hi everyone, welcome back to the channel. If you're new here, I'm PPE and this is the Peso Pro episodes where we talk about money management tips and peso tricks. If you're looking for resources on personal finance, you've come to the right place. Today, we're gonna discuss the wonderful world of investments. And along with that wonderful world, there's a lot of things that most people don't understand. In this video, we're gonna talk about the most common types of investments. And obviously, we cannot talk about all of them, but the intent of the video is to give you an overview about those different kinds of investments and how do they play in the overall portfolio of what you're going to build. In another video, which I will link to in the description below, what you will do before you invest is to do an honest assessment of yourself and your current situation as you go through the steps, and if you decided that you're done with the first few steps in order for you to be able to position yourself for success in investing, then this is the video for you. When you talk about the world of investment, it can easily become very daunting and very scary. But let's think about it in a bit more practical sense, and let's take you on a vacation to the beach. I know most of us have been cooped up in our houses, not being able to go anywhere, but let's try to imagine that we are in the perfect island and hope that we can use this as a learning example to learn about investments in a very light way. When you're at the beach, typically what you would tell your kids would be to stay near shallow waters, and that the deep waters in the open ocean are the ones that are very dangerous. The way I think about investments is that the graduation of each of those choices actually relates to how deep the water is or how shallow it may be. When you talk about investments, you often come to the concept of risk and return, which means that for the risk that you put in, you should get the commensurate return for that risk. What does this mean? Pag naglagay kayo ng pera into something na very predictable, very safe, very insured, chances are, ang babalik sa inyo na return will be also commensurate or proportionate to the risk that you are taking. Meaning, the higher the volatility or uncertainty, or if mas hindi natin alam yung mangyayari sa asset na yun, the chances are the returns would be higher or the potential loss will also be greater. Why is that so? Technically, when we invest, we put money that we have today in anticipation of a return in the future. Now, that future case is almost always not guaranteed, where you would always hear people in the finance industry to tell you that the future performance of the fund does not and will never correlate to its past performance, which is also true. Kung ano yung nangyari in the past can be a good indicator, but it's never a guarantee that it will repeat itself over the next couple of years. Also, when you think about investments, the other major thing that you have to worry about, aside from risk and returns as a concept, would be a time horizon concept. This means that when you put money into some investment strategy, you have to understand the time horizon or yung kung kailan mo kakailanganin yung returns ng pera na yun. The last one will be to manage your asset allocation across different types of investment assets. This means na when you go into the water, hindi pwedeng ilalagay mo siya all in the shallow side of the water because then yung returns mo will be too low. But if you also put everything in deep waters in the ocean, then you're also running the risk of getting all of that money into very treacherous waters and you may end up losing everything. The key is knowing where to put what amount of resources or treasures in which boat so that it gets you to the place for the amount of returns that you plan for. When you think about investments, think about them as little tiny boats that will carry your resources from point A to point B. What you will have are different kinds of boats that will traverse different kinds of waters. Let's start with the safest instruments, which is your savings deposit or your savings account. Typically, all of these are very safe if they are placed in established banks, and so they're also insured with the PDIC of a max of 500,000 pesos per depositor per bank. This means that if the bank closes because of any reason, the insurance company will actually pay you the amount of your deposit up until 500,000. Because the risk is limited in this type of asset, the returns are also very limited. Today, with interest rates falling, the typical traditional bank account will actually give you only 0.10% to 0.25% in the better accounts. And this is per year, that's gross of withholding tax. If you take away the 20% withholding tax that is levied, some bank accounts will even just give you 0.08%, which is almost nothing compared to inflation. However, the good thing is in recent months or the past year, there actually is a growth of digital banks. And you probably heard about GSave or CIMB or ING and the newer players, Como and Discartec, giving us a range of about 2.5 to 4% annual returns. This is a new blend of deposit product because your traditional banks would never give you this because they have the overhead to maintain operations. Now, the good part about the digital banks is that they don't have physical branches to cater to you. Most of the transactions are done online and virtual, and hence they can save on the costs to operate, and they're passing those savings to you, the consumer. The second type of asset that you can put money in would be time deposits or deposits with a fixed maturity date. Some of these time deposits can be up until about 5 years in the bank, and typically they would earn about 1 to 2.5% per year on average. This will depend on the bank, and it's also subjected to a set of minimum requirements. Some will require 1 million pesos, some will require lower, but assuming that you deposit more, typically banks will offer a higher percentage of interest, and they will also go and give you higher interest if you agree to a longer lock-in period. Time deposits, again, are relatively safe because they're also insured as part of your overall investment with the bank, and they're generally within the confines of a bank's operation, which makes it safe. As we go into more open waters, we go into bills or bonds. In very simple terms, bills or bonds are technically debt or utang certificates that either the government or corporations will issue. Technically, these institutions, the government or the corporation, is borrowing money from you. These bills or bonds will carry an interest rate on its face, and you will know the maturity date, also when the payment frequency is. It's normally quarterly or semi-annually or annually for some. In the most recent types of releases, in government or treasury bills or bonds, typically the interest has been about 1 to 2%. This is also because for treasury bills or bonds, it's because that they are issued by the government. They are virtually risk-free because the government is guaranteeing the amount in principal for these bills or bonds. When you go into corporate bonds, the most recent ones are passing on interest rates of about 2 to 4% in recent months, meaning these are bonds that are issued by corporations and they are the ones borrowing money from you. They carry slightly higher risk because they're individual private companies and they don't have the printing power of the state. But generally, if you invest in bonds from reputable companies, they're still in the more safe zone, if you will. Going further out into the open waters, there is now more risk that you are carrying. Imagine if your child went around 500 meters out into the open waters. The chances are you will be scared because you don't know what will happen and you don't know what creatures lie in the deep. This is the same through with stocks. And in stocks, you're technically buying an ownership share in the company, hoping for returns through capital appreciation or dividends. You don't know if those appreciation or dividends will actually happen. You're just banking on the chance that that company will do well and that will earn you money. Now, there are ways to balance this out, and that's why you have funds like mutual funds or UITFs, or even an ETF or an exchange traded fund that invests in multiple stocks so that you are hedging against the risk of one company losing or winning by buying a sample population of the total stock market. So instead of putting it in an individual stock, you're actually putting it in several stocks through that fund. Funds can also vary in terms of what assets they put into. So to keep it simple for this video, funds can either be an equity index fund, which means it's just following the PSE index, which is the top 30 stocks in the stock exchange. It can be a bond fund, which means it invests in typical bonds, even treasury or corporate, so that it manages the risks across several bonds and not just one. You also have money market funds, which invests in money market instruments like time deposits or certificates of deposit. These are also lower risk, so you can expect lower returns. And then you have, lastly, a balanced fund, which sort of blends equities, bonds, and money markets together so that you're also, again, diversifying within the total fund. Whatever type of fund you choose will largely correlate to the success or the rate of the return that you will get. If we move further out into open waters, you're actually now talking about new or not so established items like cryptocurrency, because right now they have been so volatile and the average return can be very, very high, but the loss can also be very, very big. If you compare equities to crypto, equities have been volatile, but they have been at least in the average ballpark of minus 20 to plus 30% if you take individual stocks. Obviously, there are stocks that will over and underperform these measures, but I just want to establish that for individual stocks, they can really give you a very, very wide range. I created a video which we will link to in the description below that will talk about how I lost almost 50% of a stock's value, but at the same time, I also gained a lot on another stock. So if you want to learn more about that, feel free to click on that after you finish this video. Those are the common choices of investment assets that you can choose from. Remember, the goal of investment would be to match your risk-return profile to the term or the horizon of time that you have in order for you to wait out fluctuations in the market, and last, for you to balance that with the same asset allocation so that you reach your optimal total portfolio. All of that can be very confusing, so I highly suggest that you talk to a fiduciary licensed financial consultant so that that person will be able to give you tips on what to invest in. Remember, that consultant should have your interest at heart and should be able to really realize your situation and match that and align that with your goals. All in all, when you are set to find the journey of your resources from point A to point B, there will always be waters in between. Remember, if you choose shallow waters that are very still, very calm, they tend to also give you back very minimal returns because you have that peace of mind. If you want to venture into higher risk, higher yielding investments, you also have to be prepared not just financially but also emotionally to weather the storms that will come when you put money into more volatile assets like stocks and cryptocurrency, for example. None of them are better than the other, but most of them will give you options to actually come up with the right allocation of your assets to give you the best possible return. The concept of diversification, or not putting all of your eggs in one basket, so to speak, helps you manage the risks of investments so that you are able to protect yourself from one investment asset crashing and bringing all of your boats down. I hope this was helpful, and I hope it gives you a bird's eye view of the choices that you have or investing. If you want to learn more about investments, you can look at these videos that are linked here, and please subscribe, and I'll see you on the next one.